Major support for these programs is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank, Chase Commercial Term Lending. Additional support is provided by AVR Realty Company, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Bruce Mosler, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, Chelsea Lighting, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova Burns and Gian Tomasi, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Corman Communities, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, Newmark Knight Frank, Site Comply, Sterling and Sterling, SJP Properties, Stonehenge Partners, the Wickoff Group, Urban American, and Ackman Ziff Real Estate, Ariel Property Advisors, Eastern Consolidated, Essex Capital Partners, Goldman Properties, Moynihan Group, Muss Development, RAL Development Services, the Spandrel Group, LLC, Rosewood Realty Group, Triangle Equities.
The rental market and the condo market in New York City is on fire. But where do we see the year? Where's the markets? What's the great place? Should it be the meatpacking district? Should it be Williamsburg? Should it be the financial district? So today I've assembled 4 gurus on this subject to talk about how they see the rental and the condominium market in New York City. My guests today include Ophir Yordeni, the managing member and co-founder of Stonehenge Partners, David Kramer, a principal at the Hudson Companies, Joe McMillan, the CEO of DDG Partners, and last but not least, the man who allegedly is going to give money to each one of these people on the successful properties, Steve Kenny, the regional manager of Bank of America Merrill Lynch. So, Mr. Yordeni, prior to the show, you were talking about rents, $80 a foot, $100 a foot. What's going on? I still remember when you were on my panel a couple years ago and the world was bad, and to imitate you very well, you know, when they're not working, they eat pasta, so they use the oil, the gas in my building, they take more showers, so they use the hot water, I pay brokerage commission. What has happened in a couple years?
Impersonation.
So definitely the market completely changed. I think that after the collapse of Lehman in 2008, 2009 and 2010 were horrendous for most of the landlords in New York. When I'm saying horrendous, we still had only 3 or 4% vacancies. It's not like we had 20% vacancies. We were not used to have any vacancies at all. Today, I think we are in a completely landlord market. And as I said to you before the show, our properties in Chelsea and Greenwich Village are really getting the highest rents in our portfolio, where we are averaging from $75 to $85 a square foot for an apartment. And let's not forget that these properties they do not have the amenities of luxury apartment buildings with swimming pool and state-of-the-art gym facility. So
they have elevators?
They have elevators, and most of them have doormans. So that corridor is by far the strongest one that we see in Manhattan. Park Avenue South, 8 Gramercy Park, is another great location. And
what about near my studio, Park Avenue over here?
Park Avenue at the 20 Park, 41 Park in the 30s is achieving rents around $60 a square foot. We find that most of our tenants there are either students that graduate from Syracuse or colleges in the East Coast, where the parents.
So they have a subsidy by their parents. It's a continuation.
I will. Yes, it is amazing because they like to live in the Mary Hill area, and we have close to 600 units there. But I can tell you that 25% of our tenants are being subsidized by their parents because, and as I always said, the American dream is one, to have a house, and the second one is when your kids are after college for them to go out from your house. So the parents will do whatever they can in order to subsidize. But the market overall is extremely, extremely healthy.
Mr. Kramer, Brooklyn, Roosevelt Island, Manhattan, where do you see the world today?
Location, location, location. Well, first of all, I don't want you to jinx it by talking about what a hot market it is. But, you know, we haven't really been, Hudson hasn't been in Manhattan in probably 5 or 6 years. And we're always chasing the next neighborhood, the transitional neighborhood.
But you were, you know, we were talking before about Joe, you know, you were in the Lower East Side, you were on 23rd Street.
That's
before
right.
there was a market over there in that section of 23rd Street.
Right, so what used to be Manhattan, we were the first project in West Chelsea when it was rezoned next to the High Line. We were in the West 40s 10 years ago. We were in the East Village 20 years ago. And now we're looking for the next East Village and the next West 40s. And
So for my viewers and myself, oh Guru, what's the next?
If I tell you, I'm going to have to kill you, Michael. You know, you just talk to any 23-year-old, you know, who's graduating Syracuse but not going into Ophir's building, and you see what the neighborhoods are. You know, if you want to pay $70 or $80, there are plenty of places in Manhattan. And if you want to pay $50, you can be in Williamsburg or Brooklyn Heights. And so we are always looking for the next neighborhood. So we've been in Gowanus and Carroll Gardens, and we're just finishing up a condo in Bushwick. We're about to start a ground-up rental in Kensington.
Okay, let's talk about, and I want that because I want Steve as a money guy to look at it this way. You're talking about a condo in the Bushwick, and you're talking about a ground-up rental in Kensington. What type of prices will somebody have to pay for the condo in the Wick, and what kind of prices?
You know,
because then I'm going to ask Joe, because Joe has two great projects.
I mean, each project is different. In Bushwick, we partnered with the owners who own the building. We're getting a little under, we're getting about $450 a square foot. Now, you know, in any other neighborhood, if you're doing a ground-up project, and it was an adaptive reuse. In any other neighborhood, if you're doing ground-up construction, you know, $450 could be, you know, the break-even. It could be the break-even without land. In Kensington, we're looking at rents in the mid to high 30s, and we're talking about a, you know, fairly straightforward 7-story ground-up construction. So, you know, every project is different, and, you know, the rental market is on fire.
You know, doorman,
gym, roof garden. We have these plots where people can have their own vegetable garden. So very, very green building.
Mr. Banker, I hear of 2 deals over there. How would you look at lending to him on new ground-up construction on a rental and also on a condo type of project?
Well, as you hear me say all the time, first and foremost, it's who are we doing business with, and you know, David and I.
That's why I put him on the table. Okay.
So that's the, and you know, not to look at any project that anybody around the set here has, in particular, but generically, it's who we're doing business with. So assuming that we want to do business with that particular company, those particular individuals, the next thing would be is, you know, where do rents comp out on a rental property, and what do we think the ultimate debt yield will be once they build it.
Some of it is also a little, you know, intuition or judgment. I mean, Bushwick, until recently, was, you know, a neighborhood that really hasn't seen too much condo development. Kensington has grown because of the evolution of Brooklyn going into other areas. You know, Kensington has grown as a better neighborhood.
Well, so the equalizer there, Mike, is always level of recourse, right? You're going to advance proceeds against what you can reasonably underwrite, and then you need to protect your downside risk, especially if you're going into pioneering neighborhoods. And you know, David's company's done that for years. We've done business with David in the past, and we recognize that that New York neighborhoods change, and what becomes, you know, hip or what becomes cool, and what drives that is, you know, capital infusion. But at the same time, you have to protect your downside, and as the debt provider, we would look for some type of downside protection in the form of a guarantee.
But now,
And the percentage would vary based on our perceived risks of lease up at a particular rent in that particular location.
here's a good situation. Joe has gone into a number of up-and-coming neighborhoods. You know, some of them before they became up-and-coming, and a number of them to where they are today. You know, like 41 Bond. You went in there, the neighborhood was improving, and now it's really at its height on 41 Bond. And the property on West 14th Street in the meatpacking district is the same situation. As opposed to Ofer, who's strictly rentals with the exception of the fantastic job he did at the Merritt House, and David, who has the combination of rentals, you are always a condo. Let's talk about those situations, what you're doing, and then we'll even try to get Steve's insight and thoughts on those.
I mean, I'd like to reiterate what David said. I think he's right. It's location. You know, particularly for condo. I mean, I think with rental you have a little more forgiveness in where you go into, but for us it's location first because buyers want to be in a particular area, and also design. Everything we do is very well designed, high design, because we think that, you know, all other things being equal, two buildings next to each other, the better designed one, the one that looks better, you know, people will want to own that, and those are the two cornerstones of what we do. If you look at Bond Street, beautiful block, cobblestone, you know, really it's a two-block street, but there's really one prime block, and there was other, you know, significant architecture on the block. We did very high-end, and we sold at $2,500 a foot. And
What are the size of the units?
they range from about 3,000 to 6,000 square feet.
So the market is a very unique market. They're very wealthy. I mean, 3,000 square feet, that's $7.5 million to $15 million.
The units they achieved very good pricing. There we had 10 floors, we did 7 units, because I wouldn't want to, because we have 40 units in the meatpacking.
So let's talk about the meatpacking district, which is a different neighborhood.
Right.
It's very hip. The retail is really strong, which you also have some retail on this
Correct.
one. What are you building over there?
We're doing retail, 2 floors, ground and cellar, and then condos above. And the condos there, I think pricing will be, you know, very good, but it's, you know, 2,500 is not in our base case. If we got 2,500, I think, you know, it'd be.
And what are the size of the units? Are we in the same large
There
units?
we did slightly smaller units. Units that range from 1,300 feet up to 4,000. But, you know, so we have some big ones, but we also have some more, you know, 1-2 bedroom, you know, more normal size.
Mr. Banker, how do you look at, I mean, you know, those are luxury condos.
Yeah, we've been ultra selective in our approach to the condo business overall.
You're like 57th Street, you're doing a luxury condo.
Yeah, we haven't-
across the street from Carnegie
What I was
Hall.
going to say is we haven't distinguished from, you know, luxury versus, you know, middle market. We've, you know, client, location, cash in the deal, protect your downside in the form of structure within the overall package that you can achieve. And when I say cash in the deal, not equity, cash. So cash is king. And then lastly, and Joe and I were talking about this before the show, is New York is not a pre-sales market, and we all saw that pre-sales can fall out when the economy goes the wrong way, is that we generally have sales hurdles structured into our transactions so that by date certain we know that we can liquidate the debt.
Ofer, you did the Merritt House we were talking about. David has done a number of deals, especially in Roosevelt Island, where you've done both sides. You know, you have rentals. How do you look at the condo market today?
I think it's, again, everybody speaks here about location, location, location. I think that in Manhattan, it's all about transportation. And I always call my company, it's transportation, 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 because almost every location in Manhattan is a great location. I think that the Merritt House, we did very well, one, because of the layouts of the units. We also went there and spent a lot of money in order to create state-of-the-art, from technology to the amenities to the finishes in the units. And it became very, very successful because of the location, the public schools, and I was very, very encouraged by the entire process of doing a condominium there. So I think that condo, on one hand, the high end is still selling very, very high and will continue. I think the sizes of the 3 million to the 4 million, this is where you are going to be affected in this market.
There was a study, the real estate board came out, and I look at their study as opposed to one of the brokerage firms, saying, sales were down last year, and the units between 800 and $1.5 million had difficulties in selling in a number of areas around the city. What do you see, and what do you see why that happened?
Well, we're selling units from $250,000 up to the units we have today. Maybe our most expensive are $1.3 million, $1.5 million. So we're in that range. And if there's one lesson, it's that buyers don't want to pay retail. Everybody wants a deal. Every unit is a negotiation. But having said that, there's traffic, there's activities. Right now we're selling condos in 4 separate projects, and every day we're negotiating.
What about a couple of shows of mine, even the one that I did the prior week on affordable housing with affordable co-ops? A number of people are complaining about the difficulties for people to get end loans. I know you didn't have that problem.
No, but I think the end loans is not such a big issue, especially if you are selling something for $800,000 or $900,000. The banks will provide the financing, but I think what still the consumer that buys the up to $1 million is very nervous about the economy. We are in election year. People are still nervous about their jobs, and people do not want to just deploy the capital that they have in order to buy an apartment. And the feeling is that, let me move, let me rent right now, let's see what will happen. And we see that Manhattan, that used to be 65% rental, today is above 70 or 72% rental, and the rest is ownership. So we speak with a lot of our tenants, and I think that they want to make sure that the economy will stable, and then they will go to make decision to buy.
Here is a big question, and it relates a little bit to financing. It relates, for many years, when the New York Times used to have advertisements on the real estate section, which you don't see that much today, the big item on the advertisements used to say 421A tax abatements. Today, how important is it to a purchaser in your developments and in your developments to have that tax abatement?
It is important, and it's slightly different from what David. Our units in the meatpacking district are going to start around $2 million, and so our units are kind of $2 million and up. But even in that price level, and we have buyers who are sensitive to 421A, and it's partly a psychological benefit that they want to know they have the 421A. They're saving on the property taxes. But if you model it out over the course of 10 years, taxes become significant. And so we have 421A in the meatpacking. We had 421A on Bond Street. We've had it on other recent projects we've done. And there's a couple in our pipeline that have 421A. And I think it's important. And you're gonna sell, if you don't have 421A, you will likely sell for less than a comparable project that does.
I can't think of a project that's come on recently where it was post 421A, where you couldn't buy certificates, and a project with multiple units. I'm not talking about a 7-unit building, but 50, 100 units came on without a tax exemption, high taxes. That hasn't occurred yet. Every project that we are doing or have done, has a tax exemption, and in Brooklyn, it's more favorable. It's 15 years. It's flat for 10 years. In Manhattan, after 2 years, it begins to increase. But that's going to be as sobering, and I think it's sufficiently sobering that probably, Steve has seen fewer ground-up condo projects, without 421A that they've underwritten.
How do you look at it? Without a tax abatement.
And how do you underwrite what the sales value is going to be?
Yeah, I think it's about what's the total cost to the ultimate buyer.
The monthly, the combination of the taxes.
The combination of your carry costs associated with common area charges, taxes, and a
so
mortgage.
if you give a dollar for dollar deduct to your mortgage from 421A, it's a huge hit.
Yeah, we run that analysis, with and without 421A on every project we look at, and what's the implied valuation.
But ultimately, it's about the depth of the market, right? And whether or not at $2 million unit or a $500,000 market unit, whether or not you believe that there's enough depth in the marketplace with or without the 421A to absorb the product. And generally you're looking to comp that out to see, was it absorbed? There's not going to be a lot of examples for people with projects without the benefit of 421A. So it's going to be an interesting dynamic.
But wasn't that something that always happened when you took a building and you converted it and you didn't have J51s?
It's more than that. You know, I personally am opposed to give developers that are doing condominium the 421A tax abatement. One, I think that if the buyer that is buying today the 421 with a tax abatement, and he thinks that in 6-7 years when he will go to sell his property, in essence the property will not appreciate in value because his maintenance is going to go higher. So the new buyer will have to factor the 421A, the increases, and why should I pay more for the property? And I don't see any incentives to give to the developer other than for them to make money. I rather give it to the guys that are building rental apartments. No, because, and I'll tell you why. Because it's
not self-serving.
No, it's not about self-serving. It's
policy.
a lot about providing rental apartment to people in New York. Why should a guy that buys an apartment for $10 or $20 million get a tax abatement?
Here's the answer. The answer
we
is that
are supporting it. Why?
The only answer to that is that condos and co-ops are taxed so differently that if you buy the $10 million condo and you buy the $10 million co-op, your taxes on the condo are 5 times, 10 times what the co-op is. So until those are equalized, the condo developer is at a huge disadvantage. And 421A has always been a Band-Aid to try and sort of disguise what is a huge inequality. That's the only reason. If co-ops and condos were taxed the same, you wouldn't need a 421A.
But it's also the 421A.
I just did a condo on a rehab job, and we didn't have the J51 or we didn't have the 421A tax abatement, and we were able to sell it to the consumers, and they bought it. So I think as a whole, when we are talking about crisis of rental and we want to have new construction, I don't think that by doing the condominiums, you are really helping the consumer and that you are protecting.
I disagree because construction is construction, whether it's rental building or condo building.
You're increasing the supply.
It creates jobs. I mean, first, every time that a shovel goes in the ground for a new development project here in the city, it creates new construction jobs. And some of those will be condos and some of those will be rental. Without the 421A, a lot of those condo projects wouldn't go on the ground. And so those condo projects don't go on the ground.
But maybe they will go on the rental side.
Well, yeah, but
and rental, if you look at it, you did a job, not to, I'm sure it was an amazing job, but you built a 7-unit job. How many jobs you can go and do versus if Litwin is doing an 80-20 and he's putting 500 units close to 1 million square feet. He is really.
Not everybody has as much capital.
I'm not going to take a stance here, Mike.
You're isolating,
trouble,
one building. I mean, Bond Street is a very successful building, but it is a boutique building in a very unique location. Some of our other 50-unit projects we're working on. I like to keep buildings personally under 100 on the condo side because I think the velocity is much better. They sell out better. So for the other projects we're doing. You create real jobs. You're building a 50-unit building. I mean, there's a significant number of construction jobs that are going on there. It's not as many construction jobs as a 500-unit rental building, but not every building in the city can be 500 units. If every building in the city were 500 units, the massing would be huge block to block. There'd be no light down at the street level. I mean, the city thrives on the fact that there are some 500, there are some 50, and I think that
here's what should happen. Without 421A, eventually the land prices should suffer because once certificates are gone and pipelines with exemptions are gone, and you're just dealing with a non-421A world, land prices should suffer. But what's happened over the last few years is there's been an impasse between seller expectations and buyers looking for, condominium product. And
David, land reached $400 a foot on Park Avenue South recently.
$500 on the High Line.
On the High Line.
Land's gotten very expensive.
Of which it should be expensive. You have a limited amount of land. So I'm in favor of the 421A. I just don't think they are utilizing it.
You know,
in the
we
right
know
way.
your feelings about certain boroughs. You know, and Steve has been doing some financing in New Jersey. I realize it's over the bridge, or you know, the tunnels and bridges.
Yes.
Okay, in New Jersey, Jersey City, Hoboken, Jersey City specifically, and the other property that Hartz is doing now with Roseland.
Weehawken.
And Weehawken. These are markets that are doing well because of the convenience, as you said before, David said, you know, transportation and everything else. Have you ever looked, you know, Joe, David, or you, looked to New Jersey to do something in New Jersey?
We have looked outside of Manhattan. We have a San Francisco presence too, where we have about 300,000 square feet under development. We've looked at projects in New Jersey. We've never done one. And I like Jersey City. I like Hoboken, but it's not our core area.
David?
We've sniffed around quite a few sites, never pulled the trigger.
We own and manage our own building. So we still believe that with 600,000 units that we have here in Manhattan.
How much?
No, not we. The market is 600,000. And
I knew that business was good. I know you had
the fact is that we like to be able to walk to see all our properties. And the return that we need to achieve for our investors and for what we are looking for, the business model does not work outside of Manhattan, at least for us. So thank God we were able to find enough product in the last 20 years. And hopefully by the end of this week or by the end of next week, we will purchase $500 million worth of real estate here in Manhattan. So we are able to find the product here in Manhattan. And don't forget also, most of our capital is foreign capital. And if we will tell them we are going to, where did you say in Brooklyn? Gowanus?
It's Gowanus. Como se dice Gowanus?
So if I'll call somebody and I'm saying I'm looking at Gowanus, I'm sure it's
Okay.
a wonderful area, but you have to understand.
No, I understand.
Gowanus where? So our focus.
Do you realize, I know at one time, a lot of your money came from Canada.
Yes.
And do you realize that the Canadian REIT this year went to Long Island City and they bought a building called Gotham. They paid $624 in Long Island City near the L, not far from the bus that goes to Rikers Island. And Manual Life, another Canadian company, went to Jersey City and they sold close to $1 billion of buildings in Jersey City.
I'm sure that it's very, very good for them, but I do not have all the $1 billion that I can deploy all over the country. I have a certain amount of money, and you know what? It's my quality of life for me. Would I rather walk in Park Avenue South and look at real estate, or in the meat market, or in Chelsea, or would I rather go, and I can go to a Idaho and find buildings for my quality of life, for what I like to do.
30 minutes have come and gone. So we can't continue this discussion, but we will kind of continue it later on in the year. And I'd like to thank my friend Ophir Ardeni, Mazel Tov on the new purchases of the properties and your daughter's bat mitzvah, David Kramer, Joe McMillan, and Steve Kenny. See you next week.
Thank you.